Hi, welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff's back from a week off and coming in hot with his monthly outlook. As usual, he covers so much portfolio positioning, including, but obviously not limited to, the macro picture, asset allocation, risk model review, asset class performance reviews, sector performances, and just how to overall best position yourself for the month ahead. The full notes available to subscribers on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content. Jeff, welcome back. I hope you had a wonderful trip.
Had a great trip. Great to be back.
Fantastic. And I know I haven't done justice to the depth of work in your monthly piece, but let's dive right in. There's so much to cover. Let's go with the top down.
Yeah, real quick, I'd just simply say that a number of our models have turned positive, which, we've had a bearish bent to our view for some time now. So this kind of moves us into the neutral zone at this point. Of our four major models, which would include our strategic asset allocation, our Elliot wave model, our long-term trend following model, our long-term momentum model, we have trend following and momentum having turned positive. We continue to have a bearish bent on the Elliott wave model, and we have a neutral signal finally on the strategic asset allocation, which kind of puts us kind of squarely 50-50, right? Two positive, two negative, more or less. And so, we've got kind of a neutral opinion across the board. We have been neutral on small and mid-cap stocks for some time. And we just upgraded from bearish to neutral large cap equities. The one thing I would highlight here is that neutral is not bullish, okay? Neutral just simply means that the data is inconclusive at this time. And while we are seeing some positives around the edges, our greatest concern is that the models are designed for kind of intermediate, long-term sort of trend measures. But I think that we're at a much higher degree of trend. And as a result, I think that the models could potentially be tricked at this point. And so the models are really looking at kind of this intermediate term flow of data. And our view, kind of especially informed by our Elliott wave analysis, is that we are at a much higher degree of trend than anything we've seen in the last 90 years. And so as a result, we're not putting as much emphasis on our trend following and momentum work as we normally would, simply because they will likely be whipsawed if we're right about the degree of trend.
Well, you mentioned it when we hit the risk allocation model, right? Because you said it's finally turned 50-50 on the neutral side. So you mentioned the fact that this obviously isn't bullish, right? This is about inconclusive data. How would you position yourself based on this?
The model has three areas or three degrees of exposure. Where we're kind of a risk on, if you will, we would be 80% equities, 20% fixed income. Neutral is 50-50 equities, fixed income. And then bearish would basically be 20% equities, 80% fixed income. At this point, we think 50-50 is the right allocation from a top-down perspective. We don't want to completely eliminate equities as part of the portfolio, even though, we have our concerns, right? At the same time, I believe that the downgrade from bullish to neutral is more a function of fixed income underperforming equities. And so, we're not especially bullish on long-term fixed income assets. Our emphasis would be on shorter duration and really cash as a substitute for fixed income. We think T-bills are the best value in the market right now, with a 5% yield, and really a risk-free opportunity to be paid while we wait. And I think patience is really going to pay off for investors. Those that are too anxious to get back into the market, I think will be, could potentially be sorry that they couldn't wait.
So patience and cash is king. Let's move over to the liquidity dashboard. So this is a lagging indicator, but we're also seeing some all-time record numbers being posted here. Talk us through this.
Yeah, so the latest reading, which was the March reading, showed real M2 money stock declining at a 8.6% negative rate of change. Okay, so that's an all-time record low. The interesting thing here is that we saw an all-time record high achieved during the COVID panic, right? We saw with the Fed and the Treasury just throwing money at the markets. We saw real M2 money stock spike up to plus 24.5%. That was about 150% increase over the prior record high. If we were to see, and I think it's certainly logical to expect if the pendulum swings in one direction to a certain extreme, it could certainly swing in the opposite direction to the same extreme. If we exceeded the prior record low, which was minus 6.5% by 150%, that would take us into the mid-teens on the downside. I think from the standpoint of how to read this, we're actually seeing liquidity drained from the system. And the real issue in our minds at this point is that this could potentially be a precursor to deflation if it continues. It's very difficult to reverse these trends. And when they do reverse, it's usually because the authorities take some massive action. And so the Fed would have to engage in a significant reversal in policy in order to change the direction of this trend. And I don't think that that's likely at this point.
Let's look at economic conditions and specifically here the LEI, which is the leading economic index. And you've discussed this over the last several weeks and months that we've been talking, but it does look like a recession is imminent based on this data.
Yeah, when the LEI index breaks below negative 4.2%, the kind of the red dashed line there, it's usually indicative of as a precursor to a recession. Now, historically, we usually see 2 consecutive negative months in a row before that is achieved, but that's kind of the trigger point. And once we do hit that trigger point, the clock starts ticking, and on average, it's taken about 7.5 months. Well, we kind of broke through that initially in August of last year. And so if we count forward 7.5 months, we're kind of squarely in the middle of the second quarter. And here we are, we just put up first quarter GDP at 1.1%. That was well below what expectations were tracking to earlier in the quarter. At some point, I think the Atlanta Fed's GDP now model was looking at 3.5%. So, the 1.1% real GDP growth in the first quarter, I think, was a big negative surprise versus expectations. And if we look at what the Conference Board's expectations are for the rest of the year, they're looking for 3 consecutive negative quarters of real GDP in their forecast. And so, our view is that it's highly probable that the economy, the U.S. economy, will enter at least a mild recession. But I don't think we can stop there because a lot of the data are pointing to a fairly severe recession at this point. And so, that being said, we think that it would behoove investors to position accordingly.
Okay, so that's recession talk. Now let's get back onto inflation talk. How's the dashboard looking?
Well, when we published the note on Sunday night, probabilities on the CME group's FedWatch tool showed about an 84% probability of a Fed rate hike of 25 basis points at tomorrow's meeting. That's now jumped up to about 95%. So, I don't think there's any real doubt in anybody's mind that the Fed's going to raise rates by 25 bips tomorrow. The real question is their rhetoric going to be tamed down? I think the street at this point is looking for this to be the final hike of this series that gets us to around 5 to 5.25% at the Fed funds level, and the street is pricing in a hold for the next 3 consecutive meetings out till about November 1st, and then they're looking for the Fed to begin cutting. I don't think that's going to happen. Honestly, I don't think the Fed's going to stop here. I think inflation is stickier than a lot of people believe it is at this point. We saw some evidence of that last week with the core PCE coming in up from 4.6 to 4.9%. in April. And I think that there's some question in a lot of people's minds at this point is whether or not this services inflation is going to be brought under control. We'll know for sure in the fullness of time, but at this point, it does appear that inflation at the core level is much stickier than most economists are building into their model at this point. And so it wouldn't surprise me to see the Fed continue to hike at the June meeting at least, and possibly one more time. I don't think we're going to see any cuts this year. I think it's possible we begin cutting in the first quarter of 2024. After all, it is an election year, and that stands to reason logically. But at the end of the day, I do think inflation is here to stay, and that rates are likely to remain higher for longer.
Rates higher for longer. So that obviously leads us to have a look at the yield curve, and you've got some commentary here as well. But just before we discuss the yield curve, would it be fair to say that based on your monthly piece, you would favor short duration versus long duration bonds, and inflation protected over fixed rate bonds, and also low quality over high quality credits?
Yeah, all of those models are currently under review for a possible reversal, but our current model readings suggest short over long duration, inflation protected over fixed rate coupon bonds, and right now, low quality corporate credits over high quality corporate credits. One of the reasons that I think that continues to be the case is because I think there's less differentiation between the two today, based on how the rating agencies have been manipulated to basically buy certain ratings effectively. And I think we saw that quite right in the forefront back during the great financial crisis. And I don't think a lot has changed, honestly. So I think the credit qualities that we see from S&P and Moody's, you have to take them with a grain of salt. And I think the market is pricing accordingly. That being said, these lower quality bonds, there is quite a bit of credit risk, I think, in the market at this point. And one of the things that I think will likely occur with this model is we'll get a reversal here away from low quality bonds, especially after some of these bank failures start to see, the impact flow through into the real economy with a bit of tightening of lending standards and the subsequent credit crunch that could follow. And I think once we start seeing, the extension of credit, contained, then we'll start to see the full effects of that collapse in liquidity that we talked about earlier, and that will have an impact on lower quality bonds. There's no doubt in my mind there.
And how do you see the yield curve kind of moving alongside of this?
Well, it's a clear indication that recession is a concern going forward, right? An inverted yield curve is what we see as a sign, a warning sign, a shot across the bow, if you will, that recession is in the future, right? The real question is when, right? You see these long and variable lags between big inversions like we've seen. We're 166 basis point inverted on the 3-month 10-year Treasury spread. That is the highest inversion, the widest inversion, I should say, in the last 40 years. But actually, if you look at the 2-year, 10-year inversion, that's actually tightened up. We've seen the curve begin to re-steepen. We've moved from an inversion of 89 basis points at month-end February to now 60 basis points at month-end April. And so, it's usually the re-steepening of the curve that lets you know that the torpedoes are in the water. And that's our view at this point. We think between the LEI index and the yield curve re-steepening in the 210 spread, it's imminent at this point and probable in the second quarter of this year. And so we won't know instantly, right? We'll know with a lag, and certainly the authorities, the powers that be, won't not acknowledge it until well after the recession's been unfolding. possibly even ended, right? So, this is the National Bureau of Economic Research that makes the decision, and they have a long history of being late to the party in terms of acknowledging the condition of recession.
So you're looking at the market, and you're looking at the Dow, and you're looking at the S&P, and the S&P on an equal weight basis. And you have a slide here, behold the 2023 bull market. And it kind of implies that things haven't been as fruitful as many investors might assume.
Yeah, it's actually not the Dow. It's actually the value line geometric average, which is more of an equally weighted but very, very broad average, much broader than the S&P 500. And historically, if we take a look at the data on the inset in this chart, which was provided by Yardeni Research, going back to 1928, the first 4 months of the year have averaged 2.6% return. That's since the series began in 1928, almost 95 years, right? Well, lo and behold, the equal weight S&P 500 is up a mere 2.66%, and the value line geometric is up a mere 2.59%. So right in the wheelhouse of that average return. So I think the excitement that we have over this big up move in the S&P cap weight index, as well as the NASDAQ 100, is really a function of the 7 stocks that are most heavily capitalized in the indexes themselves. For example, Microsoft and Apple represent 25% of the NASDAQ 100 and around 14% of the S&P 500. I mean, we've never seen 2 stocks that have basically represented such a large proportion of these indexes before. And so usually when they get disproportionately, weighted like that, certainly less than that, but in the past, it's not ended well. We've seen mean reversion. And so, I think I saw a chart, I forget who published it, and I shouldn't even reference it, but, it's noteworthy in the sense that if we look at the real performance, inflation-adjusted performance of the S&P 500 versus its long-term historic mean, we are now at an all-time record spread off that mean, something like over 1,700 basis points above the mean, which is an all-time record high. So usually this is a very mean reverting sort of relationship. And the question that you have to ask yourself if you're buying stocks today is, well, is the index going to go to 20% above the mean? Or is it just going to mean revert from here? I don't know the answer to that, but eventually it's going to mean revert. And you're at a new record extreme today. I don't know that I'd feel really good about pushing the edge of the envelope here.
So on that note, we've also seen some turnarounds in some of the models over the last month. Let's have a look at the Elliott wave analysis on the S&P.
Sure. From an Elliott wave perspective, we're not showing a bullish alt, and there's a reason for that. The bearish preferred count that we've been working with suggests that the June 17th, 2022 low ended a 5-wave impulsive decline, which we're calling primary wave 1 down. And we think that the rally, which came in 3 waves to the August 16th high, was primary wave 2. And that everything that follows is primary wave 3, but it's been subdividing. And the initial decline into the October low was intermediate wave 1 of primary wave 3 down. And the rally into the February 2nd high was intermediate wave 2 of primary wave 3 down. Since then, we saw a pretty dramatic decline into the March 13th low with the Silicon Valley Bank failure. We think that was minor wave 1 down of intermediate wave 3 down of primary wave 3 down. And the rally that peaked yesterday so far was probably the end of minor wave 2. And as long as we hold below the February 2nd high, which is S&P 4145 and change, then this count is valid. And we would expect an immediate decline at 3 degrees of trend at wave 3, which should be a fairly epic plunge. We got minor wave 3, intermediate wave 3, and primary wave 3 down, all simultaneously in effect right now, as long as we don't take out the February 2nd high. If we do take out the February 2nd high, then the count shifts to our alternate, which is also quite bearish. And all we're really suggesting with this count is that, okay, it wasn't the June 17th low that marked the end of primary wave one down. It was actually the October 13th low, and that it traced out what's known among Ellioticians as a leading diagonal of the expanding variety. And that the advance off of that October 13th low has all been primary wave two up. And we don't know if it's over yet, but if in fact we do take out the February 2nd high, we think there's a possibility that we could retrace as much as 61.8% of the entire decline off the January 22 high into the October 22 low, and that would get us up to around 4312 on the S&P. That's where we think the market would be heading at the very, in the worst case scenario. And we think the count would move from a zigzag to a double zigzag, which is, not unusual, a more complex, counter trend advance. But certainly there's nothing about this advance off the October low that looks impulsive to us. It is a choppy, overlapping, corrective waveform. And it's just a question of where it terminates. And where it terminates is only relevant if you're trying to trade this move. Ultimately, it's going to be followed by primary wave three down to new lows that should significantly eclipse the October 13th low that we saw put in place last year.
So, it's fair to say that the Elliott wave model is still pointing to quite an aggressive sell-off here.
We're targeting 2250 on the S&P 500 before wave A down terminates. That's a significant decline from where we're at right now, roughly 2,000 S&P points. We don't think there are many people out there that expect that, and that's why I think when it occurs, it's going to shock the system. And it will likely occur with some really bad news on the economic front, which we expect in the coming quarter. In fact, the cycle's currently pointing hard down, the 50-day cycle, and we don't see that bottoming until late May. And so we think it's really possible that from this point going forward, we could see a hard down move in the S&P into late May that will get the ball rolling in this. If we don't see that, we may have to revisit the count and go back to the drawing board. But at this point, it seems probable that we're going to see some action on that front in the very near term.
I feel like it wouldn't be a show if you didn't throw 2250 S&P at me. So, I used to have hair when we started this show. So let's have a look at the bigger picture. The longer term trend is starting to look positive, though.
Well, it's turning up. We have a trend following model that uses two moving averages. These moving averages tend to be pretty, they've got a pretty good track record of defining a change in trend, not exactly at the trend change point. It is a lagging indicator, right? And what we've seen over the past, say, 8 to 10 years is this model has been pretty accurate in forecasting intermediate term trend changes. Now, what we've seen is the most recent month, we saw a monthly close where the faster moving green exponential moving average closed above the slower moving simple moving average in red. That's our base trend model. And basically that indicates a change of trend. It doesn't mean that it can't reverse back below. It simply means that we've got some evidence that the trend may be changing here. If we overlay that with our long-term momentum model, which also gave a positive signal last month and continues to remain positive, there's a pretty powerful combination there that at least, we could get some additional strength to the upside, which suggests, that possibly our alt count, is in play here, and that we may see a rally up to, say, 4,300 or a little more on the S&P 500 index. We're not betting on that right now, but it's certainly a possibility we have to hold to. And that's one of the reasons that, we've kind of taken a neutral tact on the market, because we just are not 100% sure one way or the other. What we need to see is the market definitively move in one direction or the other. above that February 2nd high or below the December 22nd low. Those are kind of the two points that will mark a definitive change in the Elliott wave count, and likely stimulate a change in these two models that are basically models that are derivative of price, right? So whatever price does is going to show up in these models at a later date. And so, we really want to focus on price first. That's our main concern, is what is price going to do? These models are simply just confirming evidence. They're lagging indicators. They take data that kind of confirms what price is telling us. And, it puts a little more positive weight on the price. The problem is price isn't making that breakout move yet. And especially if we look at the equal weight data as opposed to this, this cap weighted data that's heavily influenced by, just 7 stocks. 7 stocks, by the way, account for more than 100% of the return in the S&P 500 cap index through the April close. In fact, the other 493 stocks had a negative return.
Wow. Okay.
On balance. Okay.
That's really something to kind of digest. You have a very interesting chart here. It's super interesting, looking at the net new highs on Nasdaq and NYSE, and it looks like Nasdaq is rolled over, or quite aggressively on its way, but NYSE looks to be following suit as well.
Well, I'd say Nasdaq's more than rolled over. It put in a new, post high low. So we just made a new low this last month in Nasdaq cumulative net new highs. And the thing is, you don't really see markets break out to new highs when, or to new highs as an index when the cumulative net new highs of that index itself is making new lows. That flies in the face of logic, right? So it really speaks to the narrowness in the breadth of the market at this point. NYSE is a little less bearish, and part of that reason is because it's made up of preferred stocks and closed-end bond funds and lots of moving parts in the NYSE index, right? Some ADRs, and ADRs have been doing very well because international has been outperforming domestic. And so, we're not surprised that the cumulative net new highs in NYSE are not plumbing new lows, but it's not like we're making new highs either. It's kind of stabilized at its recent lows, and it's kind of holding there. My suspicion is if price continues to roll over, as we suspect it will in due course, I think what we're going to see is a breakdown in NYSE cumulative net new highs. And so, that being said, I'd be cautious. I'd use this data as another piece of the puzzle that's suggesting that we shouldn't believe what we're seeing in the NASDAQ 100 and the S&P 500 definitively at this point.
So volatility, we've been talking about volatility on and off for the last several months, and it's always looked to be peaking to spike, but it just never seems to be arriving.
Well, as we've been calling for a big spike in volatility. We've been dead wrong. It's like waiting for Godot, right? It never comes. In fact, we've been left at the altar a couple of times here now with this call, and hopefully this won't be the third. But we're going to go back out and reiterate our view that we are on the precipice of a volatility spike. And I didn't show the charts that support this in this deck this month, but I will in the newsletter that comes out next Saturday. So if you're not a newsletter subscriber, there's still time. But at the end of the day, I think there is a positive divergence in the VVIX right now relative to the VIX. The VIX has made a new low, a new monthly closing low below 16% on April 28th. And at that time, the volatility of volatility index, the VVIX, actually made a much higher low. And that positive divergence in the volatility of volatility tends to precede big reversals in the trend of the VIX. And so we are suspicious here that the VIX is likely not at a position that is going to continue to move lower, but is actually registering extreme complacency in the market. And we are probably preceding a very significant rally in the VIX itself, which we think could carry VIX up to something close to, if not above 40%. In fact, I'll go out and say it. I think the VIX will print a higher high above 40% here. It'll be the first time in 2 years. And that is an indication of panic, right? When we get above 40%, that's a panic. And it can go as high as 80, 90% like it did during the COVID crash, right? But certainly above 40, 45%, we are seeing a panic. And I think we will see a panic as price enters that capitulation stage that I think is on the horizon here.
Jeff, this is your big monthly piece, and obviously you do a lot of deep dive into all sorts of markets and asset classes. You touch on developed, you touch on foreign markets as well. Can we discuss quickly on which foreign markets you might pick over others?
Well, in general terms, I'd put it to you this way. International equities are outperforming U.S. equities right now. On a 12-month and a 1-month basis, they ranked highest in our asset allocation performance positioning studies. And Europe is outperforming Asia across the board. The two worst performing markets last month were Taiwan and China for obvious reasons. There's a lot of geopolitical strife in the air in that area of the world. And it's having an impact, I think, on the shares of Asian markets, right? Meanwhile, we're starting to see the Ukraine get the upper hand on Russia in that battle. And, we got through the winter months and everything seems to have kind of worked out in favor of Europe. And so, the economies are roaring back from the depths of despair in Europe. Certainly not, big growth economies, but they're just not as bad as people thought they were. And so, we're seeing, across the board, some of the European countries led by France, which I think is a function of Louis Vuitton, which is the largest stock in that index. And we're seeing a lot of success in these high-end brands, right? And so they're kind of able to weather the storm because the consumer that supports that brand is not really economically affected by what's going on in the grand scheme of things right now.
Absolutely. While we're on the big picture macro stuff topic, why don't we have a look at a couple of macro assets? Crude oil has been front and center for the last several days, weeks, months.
We've been neutral on crude for some time now. I'm going to say mid-year last year, we downgraded it to neutral. I think we're in a range. I think crude's going to continue to be range bound, somewhere between, say, 65 on the low end of the range and maybe 90 to 100 on the upper end of the range. We probably wouldn't get bullish on crude oil unless it made a new monthly closing high. That would mean it would have to exceed 115 a barrel, at which point we would then suspect that our old view that oil has the potential to move into the $240 range longer term, $150 range near term, $240 range longer term is back on the table. Right now, it's not. And so at this juncture, we think we're going to be range bound, say between 65 and 100. That's a pretty good place for oil to be if you're an oil company. Most oil producers are making great money at $65 a barrel. At 70, they're making even better. And at 80, they're making, fabulous money. And so, if oil stays kind of in this, $65 to $75 range that we've seen in recent weeks, oil companies will continue to print money like it's going out of style. And that's one of the reasons that we've been favorable toward energy. It's actually our top recommended sector.
And what about the shiny stuff, gold? Obviously everyone keeps talking about inflation, and gold always comes into that topic.
It does. We've had 3 stabs at 2,100. None of them have held. We did post a new monthly closing high. We closed April out at 1999 and change, just below the 2,000 mark, and missed it by pennies, actually. So, our thinking at this point is that gold is a great asset to own in a portfolio. It is a recommended asset within our more detailed asset allocation models. But what I would say is that it's also long in the tooth. We've seen a big move in gold, and it wouldn't surprise us to see a pullback here back into, say, the 1900, 1850 range, at which point we would get very aggressive again on gold. As long as it holds above, say, the earlier highs that we saw, I think we're looking at like 1975 or something. Above that level, we like it. We'd remain long. Below that level, then I think we're probably in for a consolidation. Probably somewhere in the neighborhood of 100 handles. And if you can handle that volatility, then stick with it, right? If you're a trader, you might not be able to. You might want to see if you could just, blow it out here and buy it back at a much lower price, say 7-8% lower, and take advantage of that pullback. It just depends what your strategy is. But as a core asset, we like gold, no question about it.
And what about the US dollar?
The dollar's been a tough one, right? As rates have kind of pulled back here in the last several months, at least since December, we've seen weakness in the dollar, right? It's pulled back, but it's held above that par level, held above 100. And that to us is something that the bulls should be hanging on. As long as we can hold above par, I think there's a good shot that gold is putting in a wave 4 low, which means that there's one more new high on the cards. And we would suggest that if we do go into recession, we could very well see rates move higher. Okay, that doesn't really stand up to the logic that most market participants would glom onto over the last, say, 20 years. Right, there seems to be an inverse relationship, but I think it has something to do with the fact that inflation's more sticky than most people believe it to be, and very few people have ever experienced an inflationary backdrop in the capital markets in their professional careers. We basically came into the business on a post-1987 basis, so we really didn't experience it on a professional level, but we do remember it. I'm 58 years old, and at this point, I think that I can look back on my formidable years, right? As a teenager, remember how my parents struggled during inflationary times, and as a result, it had a big impact on me. And what I would say at this point is that one of the things that can happen is we can get into a situation where we have slowing growth or negative growth and higher interest rates because of inflation. It's called stagflation. And we haven't heard that word bandied about too much since the 1970s, but I think it's going to become more commonplace in the vocabulary of economists and financial pundits in the not too distant future.
So what do? We discussed, as a sector, we like energy. Are there any other sectors that you'd like or you'd look to position yourself in?
There's one that really caught our attention, and this has been a recommended overweight sector for some time now, and it's the staples sector. Staples came within pennies of making a new monthly closing high in April. I mean, pennies, like maybe 16 cents. So we were very, very impressed with the performance of Staples. I think that we're on the precipice of a breakout that could carry Staples substantially higher. And as a result, we want to just emphasize the fact that that is and remains an overweight within our sector allocation, sector rotation allocation. And so that being said, the sector that we like the least would be REITs and real estate. We think commercial real estate is going to be an area of concern within the banking system. And we think that that will continue to put pressure on the REITs. And, these guys are going to have a tough time accessing the capital markets at rates that they're used to. And I think with about $450 billion in CMBS slated to be refinanced this year, people are going to really have to go through a reality check when they see the rates that debt is refinanced at relative to what they've been used to.
It's it's certainly a hot topic. Commercial real estate really is seeming to raise some red flags across the board. Let's move on to top actionable trade ideas. Money, Jeff. What are we going to do? It's a long and short here.
Yeah, consistent with our view on staples, we're going to recommend General Mills, symbol GIS. The stock went out around 89 bucks yesterday. It broke out above 87, and that breakout gives us the ability to count a measured move to at least $102 and potentially as high as $111. That'd be about 27% upside to our stretch target. We'd set our stop loss at $86, gives us a very attractive 3-to-1 positive risk view to our lower end target.
Fantastic. And on the short side?
Yes, on the short side, we're going to go with Alcoa, symbol AA. Stock's trading around $37 at the close yesterday. If the stock were to break down below 34, that would trigger the resolution of a classic pattern top formation of the inverted cup and handle variety. We've seen Alcoa has broken trend. It's been dancing on this support level, the neckline of this pattern, if you will. And our view is a breakdown below 34 would resolve the pattern to the downside. It would project a measured move to about $13. That's about 61% decline from the trigger point, greater from the current closing price last night. We think a stop loss set at 41 would contain the downside and set up a very attractive 3-to-1 positive risk view on this trade as well. If you're a short seller, if you're a long-only manager, we think it's an avoid.
Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights, and sorry to have taken so much of your time, but there's just so much to unpack in your monthly pieces.
Well, it's always a pleasure, Mehdi. No problem.
And I'd urge our viewers, don't forget to check out Jeff's content on Substack. It's available at hugeinsights.substack.com. Until next week, good luck investing.